You would have learned on what are the golden rules of accounting. But do you know why we debit the receiver and credit the giver? Do you know why debit what comes in and credit what goes out? Do you know why we debit all expenses and losses and credit all incomes and gains? If you want to know, then watch till the end of this video. Let me brief out on what we learned. So the rules are mainly classified into based on the accounts. So one is balance sheet related, the other is trading profit and loss account related. So what are the balance sheet related accounts? It is the personal account and the real account. And what are the accounts which are trading and profit and loss account related? It is nothing but the nominal account. What is a personal account? It is nothing but anything which is relating to a person. So it could be a natural or artificial person or a representative person, like any outstanding or payable accounts. So all these are classified under personal accounts. However, what is a real account? Anything, any asset, and in anything which is owned by the entity are all real accounts, which are not non-personal related. So, if we want to classify these two simply, person-related balance sheet accounts are all classified as personal accounts, and other than person-related, all asset accounts are real accounts. What is a nominal account? All expenses, losses, income, gains are all classified as nominal account. So this is the brief on whatever we learned in the earlier video. Moving on in detail on why we have the golden rules of accounting in this format. Going to the first rule, debit the receiver and credit the giver. But why we have in this format? Debit is derived from the term debitum, which means things which is owed. That means debt. Okay, let me give an example. Say I give loan to Shyam and Shyam would be repaying me later. So what happens? Who is the receiver in this example? Shyam is the receiver, right? So for now, let us just understand who is a receiver and who is a giver. You would automatically come to a conclusion why we are debiting the receiver. But the term debit means debt. So here in this example, Shyam is the receiver. Creditum is the word originating word from which credit is the derivation of it. So we use this term in day to day, right? Credit cards. That means what? We are getting money on a credit basis. That means on a loan basis. So in our example, say I take a loan from a bank and I pay later. So in this case, bank is the one who is the giving giver of the money. In applying this in a real life situation of journal entries, what happens whenever it is someone who gives me the money or I take credit from another person, I would be crediting that account. And whenever I give to some other person, the other person would be the receiver, right? So the other person would be the debited account. I hope this was clear. Let us learn further. Just take a view of this balance sheet, right? What do you see on the left hand side? It is all owners funds and the liabilities. So as you see, your left hand side is nothing but whatever are the sources of funds, right? And whereas on the right hand side you have your assets. That means whatever the entity has invested in. So if we further try to understand on this, there is an entity, okay? For running the entity takes funds from owners, from bank, it makes credit purchases, okay? So what are all these people? All of them give money on credit, right? The term credit, which means itself that all these are credit balance accounts. That's why we are crediting these balances. And what does the entity do with the money which is being sourced from these people? It invests in fixed assets, it makes a credit sale and makes investments, and whatever are being invested in are those which the entity owns. And whenever there is an ownership, the other person is liable, right? So whenever the entity owns something, it is a debit. So automatically we got to conclude that we are crediting all our givers and we are debiting whoever is receiving it or the receiver end, right? Moving on to the next second rule, debit what comes in and credit what goes out. This is with respect to the real accounts. What are real accounts? Anything that the entity owns or all real accounts. So you have your asset accounts. Once again, we go to the example. There is an entity and the entity owns fixed asset by purchasing it, owns stock by purchasing it, and it receives cash in the form of capital. So all these are what? All these are assets. Whenever an asset which is already a debit balance, whenever there is an increase to that, that means that would also be a debit, right? And whenever the entity sells a fixed asset, sales of stock, or makes payment by cash, then what happens? The asset balance reduces, which means a debit balance reducing is what? A credit. So reduction of asset, which is a credit. This is how we got to this rule of debit what comes in and credit what goes out. And finally, debit expenses and losses crediting incomes and gains is a very simple rule which applies for nominal accounts. Let's take an example. Owner runs his entity by investing capital into the business. So for running of the entity, what happens? They make expenses like salaries, wages, purchase of stock, and spending towards sales and marketing. All these are what? Expenses, right? And upon making these expenses, the entity receives income in the form of sale of stock or sale of fixed asset or interest income from the investments. All these are income. We already know that the owner's capital is a credit balance, right? So there is an opening capital. We add the income, reduce the expense in order to arrive at the closing stock. Hope this is clear. So whatever adds to your capital is the income, right? That adds to the capital, and expenses reduces your capital. Keep this in your mind and let's see with an example. Your opening capital is rupees 200 and you earn an income of 100 rupees. You incur an expense of 30 rupees, and finally, your closing balance is 200 plus 100 minus 30, that gives you 270. So, what happens? There is 70 rupees of profit which you have made. This is what your profit and loss account states, right? So, now when you see, we already have seen that capital account is a personal account, right? So, that means it's a credit balance account. So you have your credit, and anything which is adding to your credit, adding to your capital is what? Income, right? So how do you add to your already credit balance? By crediting it, and you reduce your credit balance account by debiting it, right? Now do you see? You crediting your all your incomes and gains, and you're debiting all your expenses and losses. And this is how you got to this rule of debit all expenses and losses and credit all incomes and gains. See you soon in the next video where I'll be working out on each of these rules through journal entries. Till then, subscribe to this channel and share with your friends who are interested to learn accounts from basics. Thank you.